everyone. Thank you for joining us once again here at Seafried and Brew for our weekly briefing. I am Jamie Sumner, Chief Analyst here at Seafried and Brew, and for this week's webcast, we wanted to go over the Fed release last week, as well as the advanced estimate of the second quarter GDP in here. So first, let's look at the statement that the Fed put out. And overall, they're indicating that the labor market has continued to strengthen in here, and we see that in the job situations report that come out. That's a positive, and that economic activity has been rising moderately, and that's what we have been seeing in here. When we look at the GDP release, we can see that come through the actual numbers. Overall, household spending, they say, and business fixed investments have continued to expand, and that is in fact the case when we look at the overall numbers. However, overall inflation and the measures excluding food and energy prices have declined. So we are stuck in this area where we're seeing some good job growth. We're also seeing now in the second quarter some good economic growth. However, that inflation just is not there, and in fact it's been coming down. We see that in the PCE, we see that in the CPI, and also in the different producer price indexes that are out there. So overall, they're suggesting that it's a relatively moderate type of economy and economic activity out there. When we look further into the release, overall, they've kept the target rate the same, falling between that 1 and 1 1/4 in here, and that was a unanimous vote. They expect that conditions will continue to evolve that will only warrant, and they've had this in here for a number of quarters here, or a number of releases, gradual increases in the federal funds rate, and they anticipate it to be below levels that are expected to prevail for the longer run. So, and that's at that 3% level. So even though they went through this increasing in that federal funds rate, in fact, they're up 100 basis points from where we were back in 2015, they still say we're not going to reach that 3% for a significant amount of time. In fact, you look at the implied curve out there, and the next rate increase, the probability is at about 53% for January of 2018. So it looks like we're going to be staying in here as far as the market's kind of pricing in, staying at this level for the remainder of the year. The committee, they're continuing that the reinvestments of the principal payments and interest payments inside of their portfolio. However, last meeting they released their process that they're going to go through when they begin this balance sheet normalization program. And this quarter, or this month, when they came out, they said it's going to happen relatively soon. And with that stronger GDP that came out on Friday, we would anticipate that balance sheet normalization process will begin most likely in September, unless something happens between now and then. So that's something to look forward to when we do our quarterly briefing with Dr. Ed in September. We'll talk a little bit about that. But overall, GDP came in at a 2.6%, stronger than anticipated in here, and that's a positive. When we start to break that down and we look at quarter to quarter, we can see how much of an increase it is over where we were in the first quarter at a 1.4. During the second quarter release, they do a number of look backs and adjustments to prior quarters and prior years GDP. So some of the numbers are slightly different, but nothing to be too concerned. For instance, the last quarter they had it at 1.4 and it came in at 1.2. So we saw a little bit of a decline in here. But overall, similar to what we've been seeing, so this 2.6 is very strong in here. We break it down into the different components And we see consumer segment producing that 193 basis points of that 2.6%. Big component in here, very strong. We compare that to last quarter, and we were at 1.32 percentage points, or 132 basis points. So we saw a pretty big pickup in here. In that number, durable goods increased significantly this quarter, and that was almost led primarily by recreational goods and vehicles. That kind of led that durable good number. Also within inside of services picked up a little bit and just promoted that consumer spending. So that is very positive. On the investment side, adding 34 basis points. This is a number that we're kind of excited about, because when you break it down a little further, you'll see that the equipment number, business equipment investment, really picked up. In fact, it contributed 44 basis points to the overall GDP. However, we had to back out some for investments on inventories. That came down a little bit, not as much as we saw last quarter, but just a couple of basis points. But residential fixed investment kind of took a back seat, slid down. In fact, when we look in here, it contracted. It took away 27 basis points from GDP inside the investments portion. So we saw this big pullback in that residential investments. And we saw that in some of the residential numbers that came out with the housing starts, permits, and existing home sales. We saw in the second quarter, the first 2 months of the second quarter, that trailed off a little bit, picked up in June. So we anticipate, hopefully, next quarter we'll see that residential real estate come back and show a positive number. Government spending here, adding 12 basis points there, led almost fully by national defense spending. Very strong number in there. In fact, national defense was the only positive in the government number. We had negative changes in the state and local and non-defense numbers for the government. So that's led by that national defense budget. Exports, imports, adding 18 basis points to GDP, overall contributing 18 basis points here. That is just a continual outpacing of exports versus imports, and that is a positive inside of the number and the overall economy. And so that's what we have. Overall, fairly strong GDP number coming out here at that 2.6% growth rate. The Fed looks like they're going to be normalizing their balance sheet coming in the next quarter, and we'll see how that impacts the long end of the curve, and we'll see a pickup on the long end of the curve in that 10-year mark and beyond. It looks like we're going to see a little stabilization in the short end of the curve, so hopefully we don't continue to see the narrowing of the yield curve producing difficult times for banks' net interest margin. That's what we have for you this week. We hope to see you back here next week when we look at a variety of different interest rate forecasts, as well as we should have some numbers coming out on the banking industry in terms of performance for the second quarter. Have a great week, everyone.